from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, two trading players could be looking to tie the knot with the markets in free fall. FTX is exploring an acquisition of Robinhood. According to Bloomberg sources, Robinhood is down some 75% since it went public last year. We'll tell you where the talks stand. And we'll also bring you our exclusive interview with CoinFlex CEO Mark Lamb about why they froze all withdrawals and what they're doing to fix it. Plus, tech companies may be willing to cover travel fees for employees looking to get an abortion, but what about protecting your data? We'll talk to a civil rights attorney about the power tech companies have over your digital rights in a post-Roe era. And Theranos' Sunny Balwani, his fate in the hands of a jury at the same courthouse where his ex-girlfriend Elizabeth Holmes was found guilty of defrauding investors. We'll get the latest on where the trial stands. All that in a moment, but first I want to get a look at the markets, and volatility is back after the best week for tech stocks since March. Stocks falling again to start this week with the tech sector a big drag on the day. Bloomberg's Ed Ludlow here with the latest moves. Ed.
Yeah, it's not uncommon to get to the last few days of a quarter and see volatility creep back in as portfolio managers kind of adjust the composition of their funds. But the tech sector, certainly the underperformer. You see the NASDAQ 100 down 0.8% on Monday. That's right, after a 7.5% gain last week. It's second best week of the year. But yields are such a big part of this story. You look at the US 10-year Treasury yield up 7 basis points. When we saw that gain in equity markets, particularly in the technology sector last week, it was at a time where yields were coming down from around 3.5% on the 10-year Treasury back towards 3%. So that's quite interesting. I'm going to bring you a silver lining, Em. I always do this because you're my friend. I want optimism around this place. Look, come with me into my Bloomberg terminal chart, because we saw that gain last week, but valuations have come down. They peaked with that boost from the pandemic. And there is some evidence, if you look at names like Meta, for example, the parent company of Facebook, that value buyers have started to come back in because valuations have come down. That's important because we're still asking ourselves where the bottom for this market is. I've also got some movers for you back here in the studio. A lot of tech companies on the move in both directions on Monday. You look at the US listed shares, for example, of Chinese tech companies. JD.com, one of the big beneficiaries after an investor sold their stake in the company, which had been seen as an overhang. Amazon, a report that Amazon is considering 2 Prime Days this year, not 1, but 2. And that stock, one of the biggest drags on equity indices, down 2.8%. And then you have your big story of the day. According to Bloomberg sources, FTX is talking internally, discussing about its options about whether it can buy Robinhood. Clearly the story of the day. That stock halted for volatility, but ultimately gaining 14%, its biggest jump in 6 weeks, Em.
All right, Ed Ludlow there. We'll talk to you a little bit later in the show. Add more on that Bloomberg scoop news of FTX and Sam Bankman-Fried's interest in acquiring Robinhood. We learned just last month that Bankman-Fried owns a 7.6% stake in Robinhood through another holding company. As this news was breaking, he tweeted, "Backstopping customer assets should always be primary. Everything else is secondary." For more, I'm joined by Bloomberg's Annie Massa, who covers Robinhood, has been working this story for us. What's the latest, Annie? What do we know? What's the status of this?
So the status is that FTX has talked internally about potentially reaching out, seeing if it could buy Robinhood. And we've seen Robinhood has been pretty distressed in the months since its IPO last year. And it's led a lot of people to wonder if Robinhood might pursue a deal. Now, they haven't advanced as far as having formal M&A talks, but this is something FTX is exploring, especially after that stake that Sam Bankman-Fried took, as you mentioned.
So FTX saying in a statement, "We're excited about Robinhood's business prospects and potential ways we could partner with them." That being said, no active M&A conversations with Robinhood. Do we know how Robinhood and its co-founders feel about this?
The company declined to comment for our story. It's true that this is in the earlier stages right now, but And it's complicated by the fact that Robinhood's co-founders, Vlad Tenev and Baiju Bhatt, have supermajority voting. They control over 50% of voting power at Robinhood. So that would complicate any deal. However, you're still in a position where there have been a lot of questions about what Robinhood might do, whether it might come under enough pressure to look at a deal, and if FTX were to come forward with something, they might have to take a look.
Why would a deal like this make sense? Obviously, we know Robinhood stock has plummeted. They've had to do some layoffs. They are still an incredibly popular trading app when you ask, a typical retail investor. That said, they've been trying to push harder into the crypto market. That's FTX's bread and butter. Talk to us about, the reasoning behind a tie-up, other than the fact that Sam Bankman-Fried is interested.
That's right. So first you have Sam Bankman-Fried with his stake that he already has through a holding company in Robinhood, but there are other overlaps between the companies too. Robinhood really benefited from the huge boom in retail trading that we saw during the pandemic. You can trade equities, options, crypto, all on Robinhood. And FTX is a crypto exchange, but it's also shown interest in getting into the equities world as well. So there is a fair amount of overlap between the very retail-heavy world of crypto that FTX really embodies and the crypto stock trading, options trading for younger investors, newer investors that Robinhood represents. So you can see a tie-up of the two making sense.
All right. Bloomberg's Annie Massa will continue to stay tuned to your reporting. Thank you. Coming up later in the show, we're going to be joined exclusively by the CEO of the crypto futures exchange CoinFlex, Mark Lamb. Again, they just had to pause all withdrawals. We're going to ask for the status of that. Coming up, digital rights in a post-Roe world, how to navigate what can and can't be used against you. We're going to speak with a civil rights attorney about new unprecedented territory for big tech next. This is Bloomberg. Some of the biggest companies in the world, many of them in tech, have quickly put into action plans to help employees who may need access to abortion care following the Supreme Court's ruling overturning Roe versus Wade. Companies like Apple, Uber, Lyft, Meta, Amazon, and dozens more have announced they'll cover travel expenses for employees in states where the medical procedure is or will be banned. For more now, I'm joined by Bloomberg's Sarah Frier. So Sarah, explain to us what's happening in the fine print here and what these companies are saying.
Well, a lot of the companies are saying that they'll include abortion among the healthcare procedures that they will reimburse travel for. So often that is, if it's something that you need, they will find a way to fly you to a state where that's possible. The problem is they're not saying anything about another big question that we have here at Bloomberg, which is not just about employees, but about their investments in these states, but about the data that they collect. There's a lot of concern right now that companies will collect data just through their usage, through their searches, through their messaging, through their interactions online about whether they're planning abortions, and that prosecutors in these states where abortion is illegal might try to subpoena the companies to get it. And so far, we haven't seen a lot of companies stand up and say they won't provide that data or that they'll protect user privacy. And it's a tricky situation for them because historically, their rule has been whenever there is something illegal or something requested by law enforcement, they comply. But in this case, where they have a subject that a lot of employees feel very passionately about, and most of the U.S. Is on the side that people should be able to have this healthcare procedure, I don't know how they're going to react when prosecutors start asking for that data.
And Sarah, I know that you and your team are trying to get some answers from these companies about how they're going to handle these bigger questions. What are we hearing so far?
Well, I think that what we might see is some companies standing up and saying, no, we're not going to do that. this user data, will fight in court over not providing it to the government and potentially endangering someone. Whereas other companies will say, listen, this is the law, and we operate by the law of the land, and wherever we are putting our product, we have to do that, and so they'll just comply. And it could set up a lot of problems for a lot of people who use these services. It's very different than 50 years ago, pre-Roe, whereas now we have this entire economy around knowing exactly what people intend to do based on their online behavior. And I think that the next few years, we're going to see a lot of pain and question around what responsibility companies have to their users versus what responsibility they have to the law in the area where they operate.
All right, huge, big questions that have yet to be answered. Bloomberg's Sarah Frier, editor for our tech team. Thank you, Sarah. Now, while tech companies might be offering their employees navigating a new abortion landscape help, there are concerns, as Sarah said, about the information these companies have on their users and how it could be used against them if they try to access an abortion. Digital rights experts warn that search histories, location data, app usage could all be fair game. For more on this, I'm joined by Cynthia Conti-Cook. She's a civil rights attorney and currently a tech fellow at the Ford Foundation's Gender, Racial, and Ethnic Justice team. So, Cynthia, we're in some very uncharted territory here. Walk us through this post-Roe era and the heightened risk of surveillance.
Thank you. Yes, we are not going back in time. We are going fast forward into uncertainty. And what we have already seen happen with digital evidence used against people who were pregnant and were charged with conduct related to the termination of their pregnancies is that that information was text messages, it was email receipts, it was search histories, and websites visited. That's the information that already has been used in cases we've already examined coming in front of courts across the country.
How do you expect companies to handle this information? I mean, I wonder, is there going to be some sort of shadow economy or even a shadow society created as a result?
Absolutely. People will be pushed into shadow economies and pushed into places where they are experiencing a lot more vulnerability as a result of this decision.
So what is the power that tech companies have here to do something about it, to take a stand one way or another?
Tech companies could engage in a few different ways. They could, for example, collect less data. In addition to, I've heard a few tech companies speak to location data recently, but location data so far has not been used in criminal court against pregnant people. However, their search histories have, their websites tracked have. The other things that tech companies can do is become very prepared to go into court and actually push back against the requests that they get from law enforcement to share information about what websites people are looking up and what information they're searching for.
So you're talking about the biggest and most powerful companies in the world. So, for example, Senators Ron Wyden and Elizabeth Warren wrote a letter to the FTC asking them to investigate Apple and Google's role in all of this. What responsibility do you think these companies have?
The companies provide a very important service that allows people to access information about their healthcare. This is very simply a public health issue, much more than it is a technology issue. And the technology companies need to understand that the information they collect and store and the law enforcement agencies that they provide it to will in turn use it to criminalize the people that they are relying on to be their users and to be the people who will purchase information and commit to their advertisers. It's part of the ecosystem. And if they are disregarding the rights and welfare of the people that they are serving through the technologies that they provide, those people are going to be less and less able to participate.
Now, there are these big companies, that's one thing, but there's also a host of startups offering, women and family health care. And I wonder what you think the role is of those companies, less powerful, obviously less well-resourced, being put in a very difficult position where, in 24 to 25 states, this is all just totally fine, and in the rest of the country, it's not.
For smaller startups, I would say that they first should find out from the places that are already existing and have been serving the abortion access movement what the needs are for the questions that they're asking and for the types of services that they are considering making available. First, the people that are going to be using the service should be involved in designing it.
Now, what do you think about the role of these quote-unquote crisis pregnancy firms? Bloomberg has reported that these firms, which are encouraging women to not get abortion, are also scooping up data on women who are seeking abortion.
Yes, that's right. They are. The crisis pregnancy centers have been very deliberately, not just through in-person interviews collecting information about people, but simply through existing as a website collecting information about people that visit their websites in the same way.
So what's your advice to women right now about protecting their digital autonomy in this kind of messy middle where we are, where a lot of this has yet to be decided and this law was just overturned?
In the same way that we should not all be individually responsible for protecting ourselves against COVID, we should all not be individually responsible for securing all of our digital devices and having all the knowledge of what types of information is collected about us. But there are a few things that people can do. Secure your devices. Do not share your devices voluntarily with police officers, social workers, anyone at a hospital. Secure your communications. Make sure that you're using encrypted communication, even very casually, and that you have all of your contacts already imported. And secure your browsing. So use as your default browser the types of browsers that are not going to track you as you visit website to website.
All right, Cynthia Conti-Cook, fascinating new landscape to explore. Ford Foundation fellow, civil rights attorney. Thank you. Well, a new poll suggests that a majority of Americans disapprove of the U.S. Supreme Court's decision to overturn the constitutional right to an abortion. According to the CBS News survey, 59% oppose this ruling, including 67% of women. While 78% of Republicans support the Supreme Court's action, 83% of Democrats disapprove. Coming up, with the boyfriend of Theranos founder Elizabeth Holmes, will he face the same fate? A jury is deliberating the future of Sunny Balwani right now. We're going to have the latest on the case next. This is Bloomberg. A jury is now deliberating in the trial of Sunny Balwani, the former second-in-command at Theranos and ex-boyfriend to founder Elizabeth Holmes. Balwani's lawyers have done their best to try to separate him from Holmes, who was found guilty of defrauding investors back in January. For more on the trial, I'm joined by Bloomberg's Joel Rosenblatt, who covered the Holmes trial for us. And you were in the courtroom every day for the trial of Elizabeth Holmes. You've been in there for much of the trial of Sunny Balwani. Have lawyers been successful separating the two?
You know, we're going to find out. I'm not sure. It's just going to be interesting to see what jurors think. Elizabeth Holmes has loomed large over this trial. I was in closing arguments last week, and on one day alone in his lawyer's closing arguments, she was mentioned 96 times. So they're trying. What Sunny's lawyers are trying to do is say that he too was defrauded by Elizabeth Holmes, that she tricked him too. That's what they're trying to pull off. I think that's going to be unsuccessful.
The jury was instructed to separate the two.
Yeah.
And so you wonder if it's actually going to work.
Yeah, that's to me the kind of the real conundrum of this trial, and confusing for jurors because they got an instruction. I sent you the instruction itself. I don't know if you were able to show that,
yep.
But it asked jurors to to not consider any fact or aspect of Elizabeth Holmes's trial. And that's, read very legally and very technically. You're not supposed to consider the trial. That's okay. That's the instruction. But she has permeated this entire affair and the trial. And she, like I said, she's been mentioned so many times that it's impossible for them to, I think, separate the two of them out. And that's part of the reason he's in so much trouble.
What is your perception after spending so much time in the courtroom? Is it clear that one had more of a role than another? Or were they working in tandem?
Sonny's lawyers have said that he joined much later. She founded the company, and he joined years later. That's another way that his lawyers have tried to say this was her company, and he kind of just got duped or got pulled in. But we've seen the same texts and the same emails that were shown at Elizabeth Holmes's trial, showing how tight they were. That even he was the president of the company, she was CEO, but even in those titles, they just held a very special place at the company, special roles. They held on to information that only they could see, or they decided who could see what. So they were in tandem, and that's what jurors are going to see, and that's what they're contemplating.
And does he face the same potential sentence?
He does. I mean, part of the reason she hasn't been sentenced yet is because the judge wants to figure out his role in relationship to hers. They look to be so closely aligned that I think they're both facing between 8 and 10 years of prison.
Interesting. Now, Elizabeth Holmes, the deliberations took much longer than any of us expected. Do you think that's going to happen here?
Yeah, this trial is just it's just very different. It's been much quieter. So you don't have the media.
People showing up at 2 a.m. dressed like Elizabeth Holmes?
You don't have that. You don't have that. The courtroom's actually very quiet and almost empty. His family is sitting right behind him, just packed together, even though there's space in the courtroom. What they're seeing is it's really a very different trial. I mean, there's the same facts, but there's not this kind of energy and not this kind of pressure that I know jurors in the Holmes trial, I was speaking to them afterwards, felt to make a decision and make the right decision. I think here they could decide it kind of easier and without the pressure. So not as long, I'm expecting.
Bloomberg's Joel Rosenblatt. We'll keep following. Have you back when there is one. Thank you. Coming up, tech companies and startups are laying off people en masse, creating tough questions for employees trying to figure out whether to buy their equity. We'll discuss that and more next.
This is a moment that feels that it has been 12 years in the making.
And if you look at today's technology companies, the very, very large majority of them will survive it. The question is, do they have the strategy to thrive afterwards?
The best time to start a company is when you're in a recession.
It's clear right now the market is going to reward real companies that build real things and make real earnings.
Now we are going into a world where we're going to have to be more discerning.
I think that the place of opportunity today that we're quite focused on, continue to be, is on cybersecurity.
I would say, pick sectors that are essential businesses, essential markets, government, perhaps travel.
Also think the future of work continues to be a place of great opportunity.
A lot of companies will be absorbed and other companies will just disappear. But at the end, typically a situation like this creates a lot of new growth.
So there are bright spots, but no question we're in for choppy times.
Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Snapshots there of the reactions we've gotten from investors and CEOs right here on our show about their outlook on the market downturn, what the next big thing could be. This, as data from CB Insights shows that private capital-backed startups raised far fewer rounds of funding in the last 3 months than they did late last year, early this year. Our own Ed Ludlow here to break it all down. Ed.
Yeah, what the data shows is that deal activity across all sorts of startups is down. But it also shows what we heard from those venture capitalists and CEOs, that there's caution. Overall, between the first quarter into the second quarter up to June 23rd, the CB Insights data shows that deal count was down 23%. You can see that aggregate line, the orange line, it's dropped. Okay, it's not a precipitous drop, but it's down, and that kind of coincided with the volatility that we saw in public equity markets. What the chart does not show is that it's not just the deal counts that are down, it's not just that the VCs are writing fewer checks, they're also writing smaller checks, and that's where the breakdown becomes a bit more different. Smaller checks overall down by 27% in terms of the size, the dollar value of these funding deals for startups. But if you look, for example, at late stage startups where there was less of a drop in the number of deals, the drop in the size of the deal is much more noticeable. 43% drop from Q1 through to Q2 for startups going through Series D rounds and above. So it's interesting. We don't talk as much about private markets when there's volatility in the public markets, but the consensus, the thinking seems very much aligned that there's caution out there, but also opportunity for names that could withstand whatever's going to come next.
All right, Ed, thank you. I want to stick with this now and bring in Phil Hazlitt for more on it. He's the founder and chief strategy officer for EquityZen. So first of all, Phil, we had you back on the show in March. Where do you think we are right now in the cycle of this particular downturn?
Yeah, I think we've continued the trend since we last spoke in March, which is that, private valuations tend to lag a little bit behind public ones. And we're just kind of starting to see that reality set in through Q2, as observed through some of the CB Insights data. Something that we've seen on our side is that maybe if companies were trading on the EquityZen platform in secondaries at maybe a 20 to 30% discount in Q1 to their most recent funding round, we're seeing that to continue to go downwards towards maybe the 40 to 60% drop, which again is kind of reflective of what we're seeing in the public markets. So I think we may be reaching the bottom here, but we've certainly kind of continued the slide over the past few months.
Some venture capitalists are recommending not just 1 to 2 years of runway, but 3 to 4 years of runway. I mean, can startups really handle that when their businesses are already getting a hit?
Yeah, it's an easy thing for a bunch of venture capitalists to say. I think it's no company was really prepared to have 3 to 4 years of cash as a startup, the same way that no company back in COVID was really prepared for an environment with zero revenue for a period of time. So I think that's a bit unrealistic. I think what you will see is kind of a definite shift in attitude on how companies are spending money in particular. One of the things they can't control, as already kind of observed by some pretty significant headcount reductions. We've seen that compensation really is the majority of spend for most of these technology companies. So we'll expect to see that continue.
So let's talk to us about these folks who are getting laid off. A lot of people don't understand that employees who work at startups, half of the upside is the equity in those startups, but you have to buy that equity in order to benefit from that upside, often before you know if the startup's going to be a success or not. So when you get laid off from a company, you have a very short window oftentimes in order to buy that equity. Can you explain to us what these laid off employees are going through right now?
Yeah, absolutely. It's a tough time. It starts off by getting laid off, which is obviously a big hit to someone's financial future. It's compounded by the fact that most of these employees, as you mentioned, are issued, stock options, which basically give them the right to purchase shares of the company they work for. And that's usually a really big hook and an incentive for these employees to have joined the companies. Unfortunately, most of the rules around this say that you have 90 days to basically buy those shares after you've left the company, or even if you're terminated. So you can kind of imagine this really unfortunate scenario where hundreds or thousands of employees are getting laid off and are then given a really short window to decide if they should pay money out of pocket and incur a tax bill to own their stock or not, right? It's really uncertain to know if your company is going to be successful at this point, whereas maybe 9 or 12 months ago, it felt like a complete no-brainer. And so we're starting to see some more and more active conversations between companies and between secondary platforms like EquityZen, and also between companies and their employees to see if they can kind of help solve this problem, which is obviously a pretty meaningful one.
Then you have a company like Bolt, the high-flying e-commerce startup that actually gave employees an option to buy their shares early. I wonder if those employees are now in a horrible or very precarious financial situation because they took that bet and now it's not panning out, at least not now.
They absolutely are. And actually, when that proposal came out from Bolt Financial, whatever it was, maybe 4 or 5 months ago, a lot of the venture capitalists, particularly ones that had gone through the dot-com crash in 2000, waved as many red flags as they possibly could to say, this can end very poorly when markets kind of turn on their head. And so while it is one idea to kind of help employees with owning their stock, we can kind of think of many other solutions that I think are a little bit more palatable for companies to enact for their employees. I would say kind of the two easiest ones to do are that companies can proactively kind of convert the equity compensation they give to employees at departure to actually extend that amount of time where they have to exercise to own their shares. That's something we saw from Pinterest and we saw from Coinbase many years ago while they were private, and I think it was very well received. And something that we work on with companies is that we can help companies elect to allow employees, to sell some of their shares, through secondary transactions or private transactions to help, cover the cost of any exercise or any tax implications as well. The last one I think that we'll see that we talked about a bit before was that companies can actually redo kind of their fair market valuation, which is what's used to determine tax implications and also the price at which you get your stock options. And we saw companies like Instacart do that, and I expect and hope to see many more do that as well.
So what's your advice to employees right now? Say they've just gotten laid off, they don't know what to do. Should they buy the stock or not? How do they evaluate this decision?
Yeah, it's a tough one. My first advice would be to kind of ask the company what choices they do have with their equity. Is it really just 90 days? The second thing I would ask is if the company is aware of investors that maybe are already on the company's cap table that are looking to grow their position that can help with liquidity. I think that's absolutely the first one. And then the last one, which is obviously a little self-serving, is to kind of explore what options you have within the secondary markets to get liquidity for your shares. While the markets have taken a turn, we have seen a lot of investor interest, particularly at these lower prices for companies that they've wanted to invest in for years that they finally feel like are more fairly valued. So I encourage employees to kind of start having those conversations as soon as possible.
Interesting. All right, Phil Hazlitt, founder and chief strategy officer at EquityZen. Lots to consider. Appreciate you taking the time to walk through all that with us. Coming up, the crypto futures exchange that just halted all withdrawals. We'll speak to CoinFlex CEO Mark Lamb exclusively about what happened and how fast they can fix it. That's next. This is Bloomberg. It is time now for our crypto report, and I want to take a look at the crypto liquidity as a wave of liquidations gives rise to even more fear. Celsius started freezing withdrawals earlier this month, and then a vague tweet by a founder of the crypto hedge fund 3 Arrows Capital, which is facing its own liquidity troubles, created even more anxiety. Then came Babel Finance pausing withdrawals. Now CoinFlex, the crypto physical futures exchange, is in the spotlight. Our crypto contributor, Sonali Basak, here to give us the lay of the land. Sonali?
Yeah, something interesting here, Emily, is that in addition to the situations that you had talked about, when it comes to CoinFlex, the counterparty was not 3 Arrows Capital or another lending firm. We're going to get some more details about that in just a second, but just as equally interesting here is how the industry is being shored up in the middle of this crypto winter and liquidity crunch. We're going to talk about just how that's going to happen now with Mark Lamb, the CEO of CoinFlex. CoinFlex is looking to bring back their operations in more normal form, resuming with withdrawals by Thursday, June 30th. And one of the ways that you said to me today that you're planning on doing that is by issuing a new token. That is almost 50 million. That's $47 million worth with a 20% yield. That is a large return to investors who would get into this token. But Mark, tell me, what does this token actually represent? Who is it making whole? How is it making them whole? And what happens if you can't raise that money?
Yeah, sure. So at CoinFlex, fundamentally, we believe in markets, transparency, and tokenization. So we've done that with one of our other products, FlexUSD. It's on markets. It's funding a market, our repo market, and it's a token. And we're doing that again here with the recovery value USD, so RVUSD. it's a way for us to use tokenization to solve this problem, where we have this asset, which is it's an ultra high net worth individual. They owe us these funds. We do believe that they're going to get us these funds at some point in the future. And we wanted to make it such that the assets all match up and everything matches up in a way where it's a market-based, and we pass on this risk to investors that understand what the risk is and are eager for this risk, and basically solve the problem. Right now, we can't have withdrawals. There are lots of different ways of solving these problems in crypto finance. And crypto generally is on the cutting edge of finance. And one of the ways that hasn't been as successful in the past is when companies put their head in the sand or refuse to communicate or go hide behind the excuse of lawyers. Rather than treating lawyers as advisors and consigliaries in creating solutions that resolve the problem extremely quickly, and also in a way where more people get to participate in the solution.
Mark, assuming that this does work, that you're able to raise this token and withdrawals do begin again on June 30th, are you afraid that you will face a run on the bank in that kind of a scenario?
We're not worried about that scenario because upon this fundraise being concluded, everyone can withdraw. And so we want everything to be always matched at all times. And in situations where that isn't, we have to intervene, we have to do these things. We are going forward, we're going to take even further steps on making every aspect of the exchange transparent, including the futures positions, the notional value, not the specific coin, but the notional value of every account's positions public via an external auditing firm, and also the margin backing those positions. And we think that ultimately that's in line with our ethos from day one. We've wanted everything to be market-based, transparent, and tokenized.
What's your longer term plan, Mark, to make sure that if we experience this kind of volatility in the market again, and certainly the crypto market will experience this volatility again, it is a volatile market, that this won't happen, that it all doesn't come down to or depend on one individual?
Yeah, so part of the issue here was, and this is common practice in crypto, and really it originates from traditional finance, but we had a customer on a personal recourse-based non-liquidation account. We will be eliminating that type of account. We will also be making these positions public, and you won't just have to take our word for it. We have an auditing firm that we're going to be working with to have them publish this data. And this is much needed data in futures. There isn't a single crypto futures exchange in the world, including here in the US, that makes this data public around position sizes and the margin ratios, margin balances, and collateral backing those positions. And it is one of those things where there's a balance between transparency and privacy. Right now in DeFi, they've set the standard in terms of transparency, and we need to do at least as good as, if not much better than, DeFi with respect to transparency so that depositors and users can feel comfortable trading. It has a damage to privacy, but we think that traders are going to find that worthwhile for the additional comfort that they get from knowing the risk and the leverage implicit in the system.
So what's your message to customers right now? What's the level of confidence, your level of confidence, that in the 3 days between now and June 30th, you're going to make that date?
Yeah, I'm highly confident. We have spoken to people nonstop on phone calls and in-person meetings since this issue arose. And we have more than half of the amount needed in soft commitments to get this done. And so I'm highly confident that there's strong appetite from within the crypto space and also in the broader institutional space in this type of token. We're turning a problem into an opportunity, and we're also turning that into an opportunity that gets resolution very, very quickly. This is something where at the end of this offering, the problem is solved within a matter of days. This is something that's been done before in crypto's history, and it's been extremely successful when it's been done before in crypto.
What kind of pressure do you feel to reveal more details about who this investor is who couldn't meet the margin calls initially, especially when this new token is tied to their fortunes? The people who will be investing in this new token are doing it to make this other investor that they don't know whole.
Yeah, that's a great question. And look, I think the market is always going to demand more and more transparency. So we're going to be revealing as much information as we can as we're able to reveal that information. At this point, this is what we can give. And we wanted to very, very quickly be fully transparent about what happened, how we're resolving it, and our plan going forward to protect customers and be fully transparent to customers about all the leverage in the system and how it's collateralized. But I think the market will demand that information. I think the market will try to pursue that information, and that's the beautiful and powerful thing about markets, and that's the important thing about transparency, and I think that's what's going to happen going forward.
This one customer, I mean, how do you know whether he or she can pay you back? How much confidence do you have that you will get that money back? And what confidence can you give customers that you would remain solvent and be able to continue operations in normal form if they can't pay you back?
Yeah, so we have alternative mechanisms if we're not able to conclude this raise. We have alternative mechanisms we're looking at and we have on the table. Really, the focus is on this mechanism because it actually opens up a new type of asset for customers to invest in. And I think there's a lot of people very familiar with the situation. I think there's a lot of people who want access to this type of yield. So again, we want to turn this into an opportunity for people. We want to be totally transparent about what happened. And we also want to make it clear going forward, every bit of data about the inner workings of our exchange is going to be public. We already are extremely public about all the data in our exchange, but this is an area for us to go even further and even more cutting edge on the transparency note.
All right, Mark Lamb, CEO of CoinFlex. Thank you, Mark, for coming and sharing your side of what's happening with us, along with our very own Shanali Basic. Appreciate it. Coming up, that crypto meltdown not sparing anyone. The next is the Tether stablecoin. We'll tell you why and how after the break. This is Bloomberg. Short sellers reportedly have been ramping up their bets against Tether, the world's largest stablecoin. According to the Wall Street Journal, more traditional hedge funds have executed trades to short Tether through Genesis Global Trading, one of the largest crypto brokerages for professional investors. Some hedge funds are shorting Tether as a bet about the broader economy. And Taiwan's Global Wafers plans to build a semiconductor silicon wafer plant in Texas. That'll be the biggest of its kind on American soil. The company says the factory will close a critical gap in the supply chain. The plant is being built in Sherman, Texas. Could support as many as 1,500 jobs. And that does it for this edition of Bloomberg Technology. We're going to be back tomorrow. We've got some great guests lined up. ARM CEO Renee Haas will be here, along with Cloudflare's Matthew Prince. And this will be fun. American sprinter and the most decorated U.S. track and field athlete in Olympic history, Allison Felix. She's got a tech angle for you. We'll talk to her about that tomorrow. I'm Emily Chang in San Francisco. This is Bloomberg.